Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 25th of March. I'm Daniel Lam, your host for the podcast. The subject of gold came up in almost all the client meetings that I've recently had. Well, it is our key overweight as a class and has been making all-time highs recently. The risk-off backdrop from a weaker US dollar and weaker US equity markets lends tailwind. There are also ongoing concerns around geopolitical tensions, tariff risk, and fears of a recession or stagflation. This has led to strong ETF inflows, which looked to persist given the elevated tariff-related uncertainties at least until the 2nd of April. The key assumption here is that central bank demand is less price elastic and fiscal demand does not weaken further. This resurgence in exchange-traded product demand has been the main move in dynamics over the past few weeks. So this follows a lackluster 4 years, with net redemptions reaching nearly 550 tons at the end of 2024. This was more than offset by the growth in central bank demand, reaching over 3,600 tons over the same period. February saw the fastest pace of inflow, about 100 tons, since Russia invaded Ukraine. Substantial inflows have continued in March so far, reaching nearly 45 tons, taking year-to-date inflow above 170 tons. But we see a significant tailwind still from exchange-traded product participation, because total holdings are still more than 500 tons below the peak. ETP demand could continue to lead gold prices higher, even in the face of weakening fiscal demand across India and China. ETP investors tend to follow macro drivers, taking the cue from real yields and currency movements. So therefore, expectations of rate cuts and ongoing concerns that tariff could impact growth and inflation have led to more ETP demand. However, as per our podcast last Thursday, note that gold's relative strength indicator, i.e. the RSI, is not making new highs, while gold price is. The strength of the buying in gold, while strong, is diminishing versus February. Thus, rather than chasing gold here, investors may consider buying on dips instead, around the first support level at 2,900 and then at 2,800. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.